I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market started out last week quietly, and then bulls took over on Tuesday and Wednesday. S&Ps gained over 100 points in those 2 days as investors chased after cyclicals and low caps and those recovery stocks. We saw airlines and cruise lines up big. Transportation average had a big rebound. And materials also jumped, with aluminum moving up strongly. We saw aluminum at the highest price in about 14 years. Alcoa moved up sharply for the week, right around 12%, and FCX, that's Freeport, that moved up about 15%. A lot of bids coming in the material stocks as we see these base materials really very strong. Also, on Wednesday, solar stocks moved up strongly as Enphase showed great earnings. And with that big beat, there were some upgrades in the group by analysts. And that group got really strong. And that's a very beaten up group right now, and I think that has some upside potential, though we'd be waiting for maybe a little bit better entry levels on those stocks. Thursday, well, the bears took over. They took control, like the switch got flipped again. That came after the CPI was up 7.5%, the core up 6% year over year. That is the highest in 40 years. Bonds cracked on the news as the 10-year yields pushed up to 2.05%. That actually hits our target on the upside, and our analysis in the Treasury market has been nothing short of great. You want to learn about that? Watch our Future Speak show on Wednesdays for our members, level 2, 3, and 4. Stock indexes went into a dive that day. And they had a lot of chaotic swings as that news about inflation came out. Fell quickly to down 60 and then moved all the way back up near unchanged, then quickly fell down 35, came back again, and then down 75 quickly. It was really wild movement in there. And the bulls really had thought they had control and had it their way again, but then they really felt the pain. That also came after Fed Bullard. He came out very, very aggressive, said the Fed should raise rates by 1% by July. And truth is the Fed is way behind the curve. And the stocks, well, they ended the day down 87 for the S&Ps after being down 100 on the day. Friday, talk of a special meeting by the Fed, this emergency meeting over the weekend, really had the market nervous overnight. S&Ps were down pretty significantly, and those are, of course, just rumors. It could happen, but I think it would be extremely odd for this Fed. Right now, that would mean that they're raising rates at the same time that they're still buying government securities in QE, so they'd be tightening and easing all at the same time. Well, that doesn't make a lot of sense that would happen. This activist Fed, they're only aggressive when they're easing, as we saw during the great financial crisis, and we saw that during, of course, the COVID pandemic crisis. That's when they go crazy and they are very aggressive, when they ease. But when they tighten, they do it one little slow step at a time. That's responsible. They're responsible for taking chunks out of our buying power, based on the fact that, they'll do anything that they can to keep the markets from falling, from keeping the economy from stalling, no matter what the cost is to everybody else. So overnight, the market moved down, then recovered. Other news that came out overnight on Friday is that President Biden said that U.S. citizens should leave the Ukraine. So he is throwing out some pretty cautionary comments out there and use some words that I don't even want to repeat because I don't want to be an alarmist when we do these reports. So that made the markets nervous overnight, and they're still very nervous here on Friday. Sellers are really waiting for these upside movements, as we see, as we got these gains on Tuesday and Wednesday, and then the sellers came in very aggressively. And here Friday, it's just choppy. Traders are also acting nervously. And now, as traders, as I am, you really have to look at the wide chop that's going on. You enter too early and you get your head snapped off because these movements are just pretty severe. So important, if you're a trader, just give it a little room. An interesting article got published this week by Zero Hedge that I want to talk a bit about. It was by Lance Roberts from a great site, Real Investment Advice. And in the article, he was talking about that this stock market, of course, is trading way above trend, and that it actually could have a 50% decline and still be in a bull market. Of course, that sounds pretty absurd. And in that article, he does note that, of course, would be total destruction for investors if that happened. But he was really trying to make a case that it's so far above trend that to get to the uptrend line would be leaves a lot of room. 50% decline could actually happen. What actually caught my eye in this chart, and I really think this is an important chart to look at, is this one right here. Periods of zero returns for the markets. This is a 120-year chart. And the first half right in here really looks at this 52 years of zero returns. Now, there were a lot of things that happened in here. The great bank panic of 1907, sorry. The what's called the forgotten depression right over here in 1921, and of course the Great Depression right in here, and the beginning of World War II right there. And this was just a huge period where there were zero returns through there. But let's look into modern times and maybe these last 40 years, which are really important. There were two periods right in here of zero returns, 26 years and 13 years. You see, that happens when you get above trend by some significant amount. And here, right, you can see is the exponential growth trend for the valuations of the stock market. So here you got over trend, and it took 26 years before you could get above trend again. And here you had 13 years of zero returns right there. And that got you into this period of QE. So here's the activist Fed right over here and the QE era. And look where we are right now. Talk about being significantly above trend. The period right in here following this is very likely to be a very challenging period for investors. I really think that this is a historic period, this level above trend right over here, and of course caused by this, I'm going to call it the feckless Fed right over here, who will do anything to raise value of prices, so we all values and prices, so we all feel more rich and spend more money, and that's how they think they can stimulate the economy. But look what we're in for. I mean, there is a significant period in there of a lot of risk. A little more to say about that in here. First thing, I just mentioned these periods back in the first half of this chart. And you want to learn more about that, I'm kind of a market historian. So here we are well above trend, and you see that 52 years of zero returns and what went on in there. I'm just going to make a little suggested reading for you. Think about this book right over here, The Panic of 1907. Interesting book that talks about that period that I discussed. And here's the great book by James Grant. I'm a big fan of his, The Forgotten Depression. He's the originator of Current Yield and Barron's, if you don't know who he is. And he talks about the great, this forgotten depression in 1920-21 and the crash that cured itself. This was a hands-off period where the government stayed away. Of course, the Fed was brand new. They didn't know what they were doing yet. So, they don't know what they're doing anyway. And so this is an important book that talks about how important it is to keep your hands off and let the economy cure itself. This, of course, is a famous book, The Day the Bubble Burst, with a lot of great discussion about what the 1929 was like. So that's a very interesting book. And this book right over here, I think, is really important. 3 Days at Camp David. This is really the book that talks about how we got to where we are right now. The collapse of Bretton Woods, the way that the so-called conservative Republican president imposed wage and price freeze that stimulated the great inflationary period at that time over there, disconnecting from gold, the beginning of fiat, so the end of the sensible government's sensible monetary policies to the nonsense of what we've done since that time. So just a great book over there. Of course, commentary that I wanted to make. For 1929, of course, there's countless books that are written about that. So, but not many books about 1907 and 1921 and about how Nixon had started at that time back in 1971, where we are right now. So important readings, I thought, and I thought I'd share that with you. So again, when we talk about where we are right now, looking at this chart, I really believe that there will be books written about this Fed's insane policies in this next period of zero returns that's about to begin or has begun right over here. So look how far we are above trend. I think that's really important as we look forward and discuss and do our analysis of the markets moving forward. The conditions of the market now, just wrapping up that discussion, are really, I think, going to be dark for investors moving forward. You have to be extremely selective, be a great stock picker to take advantage of the periods that are ahead that are going to be, selectively good. And of course, there'll be cyclical upside moves that are significant, as always happens in these periods of zero returns. But of course, you've got to be really good investor. For traders, I think it's going to be a bonanza as we're in maybe a long period of higher volatility, large swings, and nervous markets. For now, the stock market, it moved up and kind of met resistance and then sold off again in a significant way. And I think we are going to be in a time period right now that these big up and down movements are likely to continue. But the risks are heavily to the downside. And I'm going to give you a picture of that moving forward as we look at the S&P 500. And I'm going to show you some risks and alignments in the world markets. And I'll bring that when I look at the end of the show at the S&P 500. For the week, here at midday, the stock market, the S&P 500 and the NASDAQ with those big swings are not far off the unchanged level. The Dow Jones Industrial Average still up something around a point, maybe a little bit less at this time, and the Russell up about 2.5%. So Dow Jones up just a little under 1%, and the Russell up about 2.5% right now. So they came in for the small caps this week. The big news really, and what really had just roiled the markets, of course, is the inflation and how that affected the bond market. So right now, yields are at the high of the week at around 2.05%. That's about a 10 basis point gain on the week. Now, our targets have been basically hit right now with our next target around 2.1% in the 10 years. We have thought that the bond market was going to be in a very risky period, and here we've talked about that in future speak. every single week, really illuminating the risks in the bond market, that interest rates were likely going to move up, and that has happened. And we're going to be talking about a bottom in the bond market coming up in future speak in the next weeks as we get past this phase. And I think what's going to happen is that the bond market is going to make its bottom ahead of the Fed. At least the short-term bottom in here. Interest rates will have a short-term peak. The Fed may act aggressively, but I'm going to show in future speak how I think that the bottom will probably come, or the peak in interest rates, before the Fed acts for the first time. The gold market, well, up about $25. It had a decent week in here, and that's mostly related, I think, to bids coming in, either as a flight to safety or the fact that the dollar has been sluggish. And the silver market, big gain, up about 75 cents. And overall, we still think for the intermediate term, the metals markets are still stuck in a range until this big consolidation ends, I think, in the summer. But right now, silver may be the best trade in coming days, as there is some room in there, and the patterns are suggestive that there may be a pop coming in there. So again, we talk about that in future speak. Dollar up about 0.3%. It's really bounced from a very key level, but it is precarious. And a lot of this chop that's going on in the dollar is about the ridiculous things that are coming out of the euro, ECB. There's tons of flip-flops in there. You don't really know what they're really going to do. Their interest rates, the 10 years, have now moved up to about 0 with their interest rate, their bank interest rate at minus 5%. So they're just ridiculous over there. And with this inflation rates that they have, they're going to have to act. Christine Lagarde may be one of the worst financial leaders we've ever seen. They're going to have to respond here, and they're way behind here in the U.S. And if they do, that could be trouble for the dollar and a breakdown. So we're looking at that. Oil, well, incredibly resilient. News is out that OPEC Plus is struggling actually to meet production levels. So it tried to move down and then bounced up again. We think the next few weeks are going to have more correction in there, with a potential move down to about $86 for the light crude market, but that would probably just be a resting period for the next move up into the 90s. And maybe even towards 100 coming up. That's the highest probability. And again, I'm going to remind you, watch the Future Speak show on Wednesday for members. It's just fantastic. Coming up, Arby's going to bring a preview of stock sectors. He does an amazing job on the healthcare sector. Do not miss. I know some of you scroll forward and look at what I say about the stock market, but we have a special for level 4 that is really, I think, offers the best of analysis and instruction and trader support available. So I've got a lot to say about that. So make sure you peek in at that. I think it's really important. And then I'm going to bring analysis on SPX. We're going to look at the 1 to 3 month view, and I'm going to compare some of the world markets and talk about the risks that are ahead for the equity markets. As we see, they are quite sloppy right now. I want to remind you, go to askSlim.com and explore our website over there. If you're new, well, you can become a free member if you want, or maybe become a level 1 member and get a taste for what we do. If you're watching this on YouTube, please do subscribe to the channel. Click the notification bell, and it'll let you know when we put up videos, which we do pretty often. Make sure you like this video. Give us a thumbs up. That does help us. On Twitter, follow us at askSlim. If you have questions about our membership info, our analysis, our huge offerings of education, please do write to Matt at askSlim.com. He is fantastic, our COO and an analyst, and of course one of the partners here at askSlim. So write to Matt at askSlim.com. Here is a preview of stock sectors. Now, every Thursday, we do some variations of stock sectors where RV basically teaches cycle analysis. He's one of the experts in the world, does a fantastic job, and he looks at a different group, or he looks at stocks that are, all setting up for trade ideas. In this case, he's looking at the healthcare stocks, and he's going to look at Danaher, and you'll get a good idea of our style of analysis. And then in every other week, he does he teaches around how to use our analysis for setup ideas for short-term swing trades. So just great stuff that RV does here. Take a look at Danaher. Danaher is not a great-looking stock right now, but you're going to get a great sense. This video actually has 15 different stocks in there, and he looks at the healthcare ETF. So again, that is for level 2, 3, and 4 members. So please do subscribe. And here is RV.
So this is Danaher, and what we see here is a very positive pattern that has now likely changed. You can see this higher cycle low here relative to the prior low, the higher cycle low here, the higher cycle low here. And now look what's happening here. We have a lower cycle low relative to the prior low after this long horizontal trading range. So what this really looks like is a major high that may have formed here in Danaher. We are in this intermediate term rising phase. We'll be watching if an early high forms in this rising phase, and then we roll over and actually break this key weekly low that just likely formed here at 264.17. So a possible major high that has formed here in Danaher. Now, what would change this overall bearish picture is if we get through this zone on the upside from 300 to around 307 and then break through the 78.6 at 319. That would say that major high is no longer the highest odds scenario. So I do want to share that with you as well. But given everything we are looking at right now, we are watching for an early high to form and then for this to roll down on the downside. If I highlight this dominant cycle right here, you can see that that next key low is only due out in July of this year. So there is possibly a lot of time here on the downside if we were to form an early high and get that breakdown. So this is something we are watching very, very closely. And as we've seen in Danaher, if I zoom out on this chart, this has been an absolute monster for many, many years. And we are possibly seeing a sign of change here.
Okay, coming up, I'm going to give you stock market analysis. But first, don't scroll forward. This is important info on our top level memberships. We are offering special now that we don't do very often, and you're going to see what's included in here in our level 4 and level 4 plus memberships. This is for first-time subscribers and for upgrades from some of our lower levels that you can take this special trial. You will get our annotated charts, our entire focus list, which has 84 of the best traded symbols in equities and ETFs and futures that could be live on your thinkorswim platform. Yes, you have to have thinkorswim, and I'll tell you more about that. You will get our proprietary studies, the option bias indicator, market condition indicator, and you're going to have grids that have our best indicators live to have on that TOS site. You'll get our grid archive, which has all of our trade ideas that you could post on there. It includes our Slim Ribbon PO and Reversal Scout. And you're going to be included in live events and now in I'll tell you more about our Discord. Free webinars where you're going to get trade planning and best practices and how to utilize our custom indicators and charts. And you're going to get in this full membership everything in level 3, 2, and 1. There is way too much for me to show you. Please go to the site and look and see what is available on our membership page in those membership levels. There is so much, too much to mention. This is a special 3-month trial, one-time use, 35% off our quarterly rates. You're going to pay $303.75. That is $101.25 per month versus regular of $159. So you get that huge savings. If you want that, please go to askSlim.com, go to the top of the front page to the special link. And if you have questions about that or the link is not working for you or something, please write to Matt at askSlim.com. That is for our level 4, but I'm going to show you more. Level 4 plus. Our level 4 plus trial, there's only 20 spaces available. Now, we've expanded our analytical team to make more room, but this is a very hands-on membership. You're going to get the ability to make custom chart requests. If you're a student of psychoanalysis, you're a student of our type of work, twice a week, up to twice a week, it's your choice. You can send us what symbols you want analyzed, and our analytical team is going to work on those and send that to you to put up on the Thinkorswim website on their platform. You're going to get our askSlim daily and weekly charts in that, and you can upload them on the platform, and you'll see this fantastic work, and they'll be live. It includes our psychoanalysis, timing projections, key levels, just a lot of things on the charts that you see, and access to our full uploadable archive of requests. So in other words, all of our level 4 plus members that make these analytical requests, we then post them up for you to see and for you to put up on the Thinkorswim platform. Exclusive trader support from our team. You can ask general questions, trading issues, trade planning, chart analysis, so much. This is really a hands-on service that we bring to you, plus everything in level 4, 3, 2, and 1. Now, this is normally $239 a month, and you can understand why, because it's just fantastic hands-on service. But we're going to offer that now for about $155 a month if you take it for a 3-month trial. So it's $465 for a 3-month trial versus $239. This is a one-time 3-month trial that you'll be able to use. And you have to reserve your spot today. The only way to get this one is to write to Matt at askSlim.com. Tell him you want to reserve that spot. We're only going to let 20 people come in as a level 4 plus member right now. And he will then put you on that list. And then hopefully if you come in fast, you'll be able to get in. So level 4 plus, fantastic hands-on support that we give to what we consider to be, top level to people that are very interested in becoming experts in our style of analysis or experts as a trader in the market. So please do write to Matt at askSlim.com and get on that list. Reserve your spot for level 4 plus. Here is some news about level 4. Then level 4 plus, we are now opening up our new Discord server. This is an opportunity to learn and grow in a community of like-minded traders. So no, you won't be alone anymore, and you'll be able to interact with us. Live interaction with the analytical team throughout the week as we review ongoing trades and take your questions. And we open the floor 2 to 3 times a week in what we call our office hours, where you can ask questions on technical analysis, strategic approach, option strategies, trading psychology, and more. And you're going to get even more. First of all, this is a peek at a look at all of our channels and what the Discord server looks like as we are coming now out of our beta. It's really going great, and have all of these channels on the left that you can ask questions about all our analysis, and of course on our open office hours you'll be able to be live or in our community. All absolutely fantastic. And as a special, we're going to give you this bonus gift for level 4 and level 4 plus, our askSlim Market Monitor. Many of you have seen me demonstrate this. You can scan and sort your personal watch lists or our watch lists that you download, and you'll be able to get our directional bias and momentum indicators in there. The reversal scout and the slim ribbon and the market condition indicator and the option bias indicator, all of this to be able to scan just at a glance. It's fantastic, built with our proprietary studies and indicators. So you're going to get this as a bonus if you become a level 4 or a level 4 member. Question, write to Matt at askSlim.com. Thanks for listening. I know that was long, but we have so much to talk about when we talk about these great level 4 and level 4 plus members. One more thing. The level 4 requires a Thinkorswim account. So go to askSlim.com to the front page. Scroll to the right, actually, to the TD Ameritrade sign-up page, and click on that logo to open an account. They are our preferred broker. You see all of our work is done on there, and we get credit for that. So please do open up a TD Ameritrade account. All right, let's talk about the stock market right now. The stock market is in a condition where it has weakened significantly. Now, we've seen quite a number of weeks in here where the stock market has come off of its highs, and the SPX, I'm actually going to show SPX, not SPY. The SPX or SPY, fell about 12% and then rebounded, and bigger declines by the NASDAQ, about 16%, and 22% by the Russell, which had a little bigger bounce this week. And the world markets have actually been in declines for a longer period of time. Well, it kind of aligns with the breakdowns of a lot of the stocks that did well from the pandemic, and the tech stocks that really started to come apart on the discussion of the interest rates going up. So it was a kind of disguised breakdown for the U.S. market. Well, it wasn't so disguised for the FEZ, which is the European market, and the EEM, which are markets that are really around the world, emerging markets, they call that. We're going to look at all of that right now. We're going to start out by looking at the SPX. So here is the SPX, which is a look at cycle analysis. Let me just move this out by a little bit more in here. You could see what we call this larger harmonic families in there. And the movements that are in here, as you could see, these are what's called cycle brackets on the bottom. Some people write me, what are those half moons or half circles are on the bottom? These are a drawing tool. I mean, these are not the cycles, but they're a guide for us. They tell us where to look for the energetic forces in the market. Our analysis looks at three major components: the cycle analysis, which is the energetic movements that you see right in here; the condition of momentum, which is reflected right over here on our reversal scout, which I just spoke about, which is available for our level 4 members and level 4 plus, and our support and resistance levels, which are very key, and we have videos in our video library about how we do the swing high, swing low analysis. Each of these dominant cycles that you see right in here are made up of actually 3 minor cycles, and those are illustrated right in here. And these have all 1, 2, 3, 4, 5, 6, 7 in a row were all what we call positively configured. Higher highs, higher bottoms, that gives you the uptrend. This one changed and is now negatively configured with another whole period right in here where it is likely to move to the downside. When you get into periods where they nest or 2 of them come down together is where you get your biggest declines. When you add in the much bigger cycle right in here, and that is the 20-month ideal cycle that you see, that happens to align with declines that are coming up in 40 and 80-month cycles that have important troughs in the spring, summer, and maybe even out into the fall. That puts a lot of downside pressure in the market. So in this case, right over here, you have 1, 2, and 3 cycles that have energetic forces coming down. If you want to think about what this looks like, it would be kind of the shorter-term holders, the intermediate holders, and the long-term holders. For the long-term holders to start to liquidate, they have to really be under pressure, and we're coming into a period where that is coming up, and that means a lot of supply could come onto the market. Let me just take a little closer look right in here as we look at this, and we want to consider the fact that this big decline came down 12%, came into this resistance area, and you could see what's called a tweezer that formed in here. There's 2 high waves right there. It's suggesting that this level right there, which is the 50% retracement, is stopping it. And here you could see the askSlim reversal scout in negative momentum condition. When you get into shorter term negative momentum conditions, which we've been in and out of, those set up for downward impulses. So for those of you that are members and use the slim ribbon, which are slim ribbon PO, when that turns red and this is red, you've got periods of trouble. And we think this is a period of risk. Each of these yellow zones are a period of risk, and we have that right over here. That is suggestive of a decline coming. Now, it's the probabilities of taking out 42.24 are better than 2 to 1, maybe even 3 to 1, based on this structure that we're looking at here. It could come down here, get support at 4,200. It could get down here to around a 50% correction level of around 4,100. And if it wants to get way down to this major 38, which would be just over a 20% bear market, that's around 3,800 down there. So this is a period of risk in here, and these rallies should fail. Now what I want to do is I want to compare a little bit as we look at the FEZ. Now remember, this is pointing to a decline out into these two vertical lines, kind of give you the principle of variance right there, where it could early bottom in mid-March or late March, or it could go all the way out here into beginning of May, depending on how long the selling process takes. Now, if I look at the FEZ in here, which is the Euro stocks, you can see something very similar. It's interesting that while the U.S. market peaked out over in this area, this one actually peaked way back here last June. Now, it gave you this negative period right in here, which you can see is a nesting. There's those similar cycle patterns right there, and this period of risk right down over there. It's likely the downside risk goes into late March into May. That's very similar to what we see in the U.S. markets. And here are your supports and support confluences, which come off of these major lows that come in here. And you could see that it's pretty reasonable that it's going to get below 43, which would only be, another 5% or so, but maybe the way down over here to 41 or into this area is under 40. So this is your period of risk, very much in alignment with what we see in the U.S. market. Again, you want to learn more, go to askSlim.com and go to our cycle analysis page. And there's a video there that introduces cycle analysis to you. It's very informative, so watch that over there. So this is the Euro Stocks 50, and FEZ is the symbol, and you could see the beautiful formations of flags. In our cycle analysis workshop, we teach how flags form, how the minor cycles fight against the dominant cycles. In this case, dominant cycle had an upward force, so did the minor, and you see we got above and tested the high. In this case, it didn't test the high. It tells you this force over here is gaining a hold, and you can see that happening as you create this negative shape in here, and both of them about to come down on the downside. So that is a look at FEZ. Now let's take a look at EEM. And you can see, looking at EEM, there's similar things going on here. This happens to have what we call out-of-phase cycles. So there are two cycles that are exhibiting force in here. You can see the bottom right there and there. That's the blue dotted one there and right there. And overall, this downward trend you see comes all the way back to last February. So the emerging markets have been in this declining mode for some period of time, pretty significant. They're actually down about 20% at the extreme from their peak, and some people would actually declare that to be a bear market. Now you could see these out-of-phase cycles nest out over here in June. That is suggestive that the pressure could still be in these markets way out into the summertime right there, which we think is a possibility based on our monthly patterns. So this you could see negative configurations, this downward trend going on, and the likelihood of a decline coming out into June here in the emerging market. So we looked at the emerging markets, we looked at the European markets, we looked at the U.S. market, and all of those in alignment for downward movement, taking you into spring and potentially into the summertime. That is suggestive that equities are going to be in a problem time frame in here. There will be a period coming out sometime, probably in the late spring or summer, where if these declines occur as the analysis suggests, and remember, our analysis is observational and probabilistic. When we bring it to you, we always know that there is some probability it will turn out differently. And when I look at the structures, I would make it at least 70-75% likely that this period of risk is going to bring declines in the market into this time frame. So, of course, we could always be wrong, and we will look at when the markets change and see if there are important messages coming out of that. Right now, it looks negative. One more little peek right over here at the S&P 500 for you to see what I just suggested was happening and how that compared to the European and emerging markets. And this decline out over here is likely out into the late March through early May timeframe is the way that is aligning right now. So that's a look at SPX and at the stock market for coming months, really outlooking as far as about 3 or 4 months in there for the major markets of the world. I hope you found that absolutely incredibly illuminating. I want to remind you, if you scrolled forward to watch our analysis and didn't see the earlier part of our show, we have a fantastic offer for our highest level membership. Go back and look at it, because I know lots of you either scrolled forward or are watching this on YouTube and didn't get to see the whole show. So please go watch the whole Market Week show, and you'll see that great information, including the analysis that RV did on Danaher and discussion about the group, that whole healthcare group. And of course, my monologue at the beginning, which I think has got valuable information and discussion about periods of zero returns, which I think we're getting into right now. That is everything I'm going to show you for the stock market this week. Please remember, go to askSlim.com, become a free member, level 1 member, and learn about all the things that we're doing. If you're watching this on YouTube, please do subscribe to the channel. Click the notification bell, like this video, give it a thumbs up, and watch member videos in our playlists, and there's past shows in there I think you'll be very interested in. On Twitter, follow us at askSlim. And for our membership and information on our huge offerings of education and analysis, write to Matt at askSlim.com. I want you to be so incredibly careful. It is so crazy out there. And I'm always wishing you great trading.